Hey everyone, how you doing this morning? As I shared in the daily financial news, we got Jonathan Twomley with us, part of our expert series. How you doing, sir?
I'm doing great, Michael. How are you?
I got a little smile on my face this morning. We finally broke what I'll call a psychological kind of threshold with new unemployment claims. We teased it last week. We thought kind of the weather bump from last week in the South would allow us to get under that number this week, and we did. So why don't you kind of share the details that you saw, and we'll talk
Yeah.
about it a little bit.
So for the first time since this all started, we are now below the previous historical record for new weekly unemployment claims. So we broke that 700,000 barrier and kept on going, and we're under the previous record of 685, which
Yeah.
is really, really good news. I mean, I think it just shows that, you know, vaccines are taking effect, people are feeling better, spring is here, like all these things are kind of happening at once. Things are opening up again. There's a lot more confidence returning to the economy,
Yeah.
and it's starting to roll. And I think this is just really good news, and I expect that we're going to see continuing downward trend. You know, unless people get stupid and they stop taking precautions. There has been a recent spike in new cases as people have gotten a little too enthusiastic. That could go the wrong direction if people are not careful.
Mhm.
And I think a lot of people are not realizing that even if you're vaccinated, you can still spread it. You just won't get sick,
Mhm.
but you can still spread it to others who are not vaccinated. So I think that, like, as much as people hate it, the masks and the precautions and the social distancing are still necessary until this thing is really
Yeah.
under control. We're kind of like we're almost there. Just a little more push to get this done, and hopefully people can kind of just have that last reservoir of patience for this
Yeah.
to get it over the threshold. But
Y- y-
the trends are in the right direction. Let's put it that way.
Yeah, I mean, to put it in perspective, I actually went back and looked. 684, 685 number this morning was awesome. And to put it in perspective, that is lower. We have to go back to March. What did I say? March 14th of last year. I actually wrote it
Yeah,
down. Yeah, March 14th of last year. So 54 weeks
yeah,
to find a lower number. That's first just tells you how deep and dark we were in, but I'm starting to tell people we're right at the end of the dark period. It's almost gray now, if you know what that's like, right? As the sun's coming up, it's kind of that gray, and we have brighter days ahead. And I think what you're going to see is you're going to see the American economy and really the world economy kind of, capitalism is going to start working, right? You're going to start seeing grand openings. You're going to start seeing people hire ahead. I mean, just today, United Airlines, probably the hardest hit industry, air travel, is making strategic
yeah.
bets. They're adding flights to, let me say, I actually wrote them down: Cleveland, Cincy, Columbus, St. Louis, Pittsburgh, Milwaukee, Indianapolis. Why? Because they think people are going to want to get on airplanes and go to warmer places.
Well, just along those same lines, my wife, who is in the travel industry, uh, her company has not come back online yet because they do basically like tours of New York for Japanese tourists. But she also, one of the things she does on the side is she writes for Japanese travel blogs. And so just yesterday, one of these travel blogs that she hasn't heard from for a year reached out and said, we want you to start writing again about New York City.
Nice.
So so clearly they're gearing up to start marketing trips to New York again. And so
It's
that's good.
coming.
And I've been seeing actually all the restaurants in my neighborhood got, like, hiring now signs up. Like they're all
It's,
getting ready to
yeah,
start
it's going to
to
be
start this up again.
fun.
There's going to be it's going to be pretty rapid. I mean, and look, the Fed is predicting nearly 7% growth for this year, which
Yeah,
is just
it's amazing.
astonishing, right?
Yeah, for
We've
the
never seen
US,
anything like
amazing.
that. Yeah, and they revised the fourth quarter numbers to
Up.
over 4%.
Yeah, 4.3 versus 4.1. Again,
Yep.
it's going to be that transition from dark to gray to light. Q1 will be better than Q4, Q2 better than Q1, Q3 better than Q2. Folks, you better get ready. The other, yeah, it's finally going to be fun, Jonathan.
Yeah. Yeah, exactly. I think, and that, I mean, listen, there's a lot of pent up demand, as we've said, not for stuff, because people have been buying a lot of stuff to keep
Ex-
themselves occupied. There's going to be a lot of pent up
experience.
demand for experiences, services, having fun, going
Yeah.
out, being around other people again,
Yeah.
traveling, seeing.
Disneyland's going to open. Did you hear? LA, they're going to open Disneyland.
So we will. This is going to be an interesting time, and I mean, I don't know how it's going to benefit real estate more than real estate's already been benefited by what's been happening over the last few years. But I mean, I think over the last year, I should say, I think where you're going to see, places that have had like really strong population movement and that had a bit of an accelerator poured on that over the last year because people just wanted more space, or they just wanted to get like, hey, I'm stuck in Manhattan, there's nothing to do, why am I here? Like that has had a big bump. I think you might actually see the reverse happen,
Mm-hmm.
where like that spigot maybe doesn't get turned off, but it gets really like slowed down
Yeah.
because so many people, right? If you think about like the long-term trend, there might have been a long-term trend to like over. I mean, I'm just going to pull some numbers out of the
Yeah.
out of the air, but
I do all the time. You might as well.
yeah, no, but let's just by way of example. I mean, let's just say that you've had on average 100,000 people a year move from New York to Atlanta, right? Let's say that's the number,
Yeah.
right? And maybe the last year we had 300,000
Gotcha.
move. You have reversion to the mean. So what you probably may go down to like 50,000 now because so many people who wanted, you basically got you got 3 years supply of people.
Yeah. You pulled forward, right?
You pulled forward. That's what I'm looking for. So you might see the opposite happening. And there's a little bit of evidence to suggest that like rents have dropped so much in places like Manhattan that now there are all these people who are like, hey, I can afford rent in Manhattan now. I don't need a roommate anymore. Like so you're starting to see that kind of stuff happening, and you're probably going to start seeing some modest, the occupancies are going to get back up. You're going to see that kind of modest rent increases start to happen as all this happens. And we've also, another big thing that happened in New York this week was that Mayor de Blasio actually ordered all New York City workers back to in-person work.
Ooh, I did not hear that piece.
Yeah. So that it's not businesses do what they want, but
Yeah.
the New York City workers are all coming back to. I don't know what the time frame is, but the announcement was made that they're all expected to come back to work in person. So and it was like specifically as an example to the rest of business, like, hey, time to bring folks back now.
Yeah.
So
it's going to be interesting. Let's be clear. I think you brought up something that I wanted to talk about, and we'll do a little bit more in episode number 2 to tease it. We're going to hit interest rates hard. So we'll leave that part out. But, we are seeing a transition, right? From dark to light. But to your point, I don't think it has to be good for real estate, right? I think the last 14 months has been unquestionably good for most real estate. Bad for office, bad for hotel, bad for urban. But generally speaking, nationally, it's been pretty damn good, right? 15%.
Any kind of residential.
Yeah.
Residential, right? Yeah.
Pretty good up, right? But let's talk about what kind of happens, right? If we keep that transition, that excitement you and I just had about business openings and rehirings and entertainment, what else would that probably mean? For me, the one thing I've been anchored on, and I want to see what you think of this, is I think that move up buyer who has been for the most part staying home and not wanting to really sell their house. Because again, the move up buyer is interesting. It's not like the millennials who are going from apartments to home ownership where they just take one off the market, right? They sell one, they buy one. And I believe a lot of them have been like, whoa, I'm going to paint my bedrooms. Maybe I'll change the countertop. But now they're going to be like, hey, let's take this equity. Let's get out of here. Let's go get a golf course, get a newer home, change our area of town. What do you think about the move up buyers? And again, that may be bad for pricing, right? If millions of move up buyers suddenly list their house April 1st, I mean, that could slow prices. I mean, I'm just playing it out.
Well, yeah, that's just sort of basic supply and demand, right? If suddenly we see a lot of people listing their homes and there's more competition, then it's gonna have some effect on pricing.
Mm-hmm.
And
at least slow it down, but yeah.
Yeah, exactly. And I don't know where and actually it already has slowed down. I mean, I don't know if you caught this, but February, because interest rates moved up a little bit, it really whacked the volume of new sales of homes.
Yep.
But so, and that kind of makes you think like, well, if new home sales are so sensitive to a little movement in interest rates, we're not talking about a lot of movement, right? We're not
Yeah.
talking about going from like 3% mortgages to 6% mortgages. We're talking about
That
going
would
from
be a
like,
problem.
right. But I mean, but you could understand how that would
Yeah.
affect things.
Yeah.
But we're talking about going from like 3.25 to 3.75
You're right.
on your mortgage. And that has had a big effect. So it just shows that, something is out of whack if such a small movement can affect the, interest, affect the market so much. And probably what it is that prices are too high for most people, right? They were able to afford them at like at a 3.25 mortgage rate, but when it goes up 50 basis points, then now they're suddenly out of the market. So
Yeah.
I think if we do have, I think inflation again, that's just or interest rates, right? And they're tied to inflation. But also, interest rates are also driven by something else, right? Interest rates are not just driven by inflation, but they're also driven by demand for money, right? And the more, you know, you could kind of theorize a situation in which, with the economy growing as fast as it is, the demand for new loans is going to be very strong, and banks are going to start raising interest rates, partially because they can, but also partially because they'll do it to intentionally reduce the demand, right? I mean, they can't keep up with the demand, so they will increase interest rates, just like they did last year when everybody started refinancing all at once. They were like, we can't keep up with this, so we're
I remember.
going to they didn't raise interest rates, but they eliminated whole categories of stuff that they would lend on.
Yep.
Right. And because they just couldn't keep up with the demand. So you could see banks raising interest rates in because of more demand for loans. So if we start seeing a lot of demand for like new small business loans, for instance, as people are like trying to gear up and get ahead of like the reopening, that could cause interest rates to rise, right? Or inflation, or what we've got, the stock market or the bond market, I should say, is convinced that there's a lot of inflation coming, so they've been selling bonds and raising interest rates, and there's nothing the Fed can do about that, right? That is going to cause interest rates to rise. And I mean, they can try to buy bonds to prop up the price, but it's very difficult for them to buy enough to keep, the interest rates from rising. So that'll have an effect. And the Fed keeps on coming and saying, we have no fear of inflation. We think inflation is going to, they came out and said they think it's going to be 2.4%, right? But the bond market thinks otherwise, right? And look, that's also, what they measure for inflation is so limited, right? It's not. I mean, I continue to think that the measure of inflation is crazy, and we would have a completely different, monetary policy if they measured the stuff that most impacts the cost of living for people. Right? If they measured rents and mortgage payments, then they would have a completely different measure of inflation, and we would have much higher interest rates. In fact, I think higher interest rates are better for the economy in the long run than lower ones.
Oh, these are certainly these artificially low ones. Yeah.
Yeah, but again, think about trying to save for retirement right now. Like think about like if you're nearing retirement, then you need to be like getting compound interest, compound returns to build a nest egg, and then you want to have an income in retirement. You can't do it with the interest rates where they are. You need to have like nice, healthy, 6 or 8% interest rates. And there's a lot of people out there like, boo-hoo, if we had 8% interest, the economy would grind to a halt. Well, let's just look at where interest rates were for like most of history.
You're right. Yeah.
And they're around 6 to 8% most of the time. And the price of everything just adjusts, right? But now we've kind of grown this enormous financial bubble over the last 40 years, and it requires lower interest rates to keep the bubble from bursting.
Yeah.
But it's not, it benefits some people. It benefits people who own assets, really hurts people who don't own assets, and it makes it almost impossible for anybody to generate a retirement income. So I'm gonna put a stake in you like putting stakes in the ground, but I'm gonna put a stake in the ground here, which is that Generation X and the millennials will never be able to retire. They will never retire because they will not, there's no way that they can generate any retirement income. I mean, putting aside the fact that they haven't saved enough money to retire,
Yeah.
even if they have, you know, let's say you have $1 million nest egg, when you get 8% interest, that's $80,000 a year. And if you're like, you know, if it's passive income, you're paying lower tax rates, your mortgage is paid off, you can live quite well in most places of the country on $80,000 a year.
Sure.
Right. If interest rates are 2%, your $1 million is generating $20,000 a year, and you can't live really anywhere on that. Right. Yeah. So retirement is gone. Right. And that's going to continue to drive wages down because there's more people competing for jobs.
Yeah.
So the low interest rate environment basically sucks for everybody. Let's just put it out there. Except for like real estate investors who keeps going, but if there's a crash, it doesn't help them either.
Yeah.
Right. So.
Well, this is great. So one of the things I would tell you here, folks, is if you're going to get on the one rental at a time aspect, go get your 4 single-family rentals with 30-year fixed rate debt. So when you retire, they're paid off and you collect rents going forward. And Jonathan, you have an announcement. You got something ending in the next day or so. Why don't you tell people what that is?
Yeah. So we're in right now one of 2 annual open enrollment periods for Multifamily Launchpad. If you want to come and, you know, learn how to do multifamily investing the right way, learn everything that you need to know about this process from A to Z, plus get my advice in real time on practically a daily basis, ends tomorrow. So if you want to join Multifamily Launchpad, you got to do it in the next basically 48 hours from the time that we're talking right now. Actually, but more like 36 hours. So be sure to go check out the website, multifamilylaunchpad.org. And if you want me just to add you to the email list so you get the emails, just email me at jonathan@multifamilylaunchpad.com. Right, it's a little confusing. The website is .org. The email address is .com, but it's still Multifamily Launchpad either way. So jonathan@multifamilylaunchpad, all one word, .com. And I'll just manually add you to the list and you'll get the emails and you'll learn how you can sign up.
Very, very cool, Jonathan. Thank you very much, folks. Topic number 2 is going to be one you want to pay attention to, and that is rising interest rates. Thanks, buddy.